Hey all, Q.A Tobi here. Today I'll be answering the question, has the 21st century's growth of private equity made stock ownership less democratic, more concentrated? Our first answer is from Abhepand. The growth of private equity has made stock ownership more concentrated but more democratic. While it is true that individual investors have less impact than they otherwise might, so do corporate management and crony boards. And by reducing some types of managerial discretion and installing more competent boards, private equity investors make companies more answerable to shareholders. Individual shareholders, and most non-activist investors, have historically been ignored or patronized by company managements, who have in many cases proceeded to destroy shareholder value through expensive corporate jets, big headquarter buildings, excessive management compensation, and empire building M&A. This is not the shareholders' fault. They typically are constrained for time and pay little attention to any single investment. Private equity provided a vehicle for some investors to pay attention to companies and actively advocate for shareholder interests. In this way, they make the system more answerable to shareholders. Some aspects of pay activism may be bad: a single-minded focus on profits and share price, a short-term orientation, still longer than most shareholders, and the use of excessive leverage. But overall, their impact on forcing company management to act in the interests of its shareholders is significant. Our next answer is from John Wichtenberg. It depends on what you mean by stock ownership. Public markets have shrunk considerably since the passage of the Sarbanes-Oxley Act of 2002. While the law has done wonders for investor confidence and reduced fraud, the costs and benefits of Sarbanes-Oxley, the cost to comply, has kept many companies out of the public markets. The rise in private equity is partially due to reduced supply of public investment opportunities, but it's more likely due to more efficient international capital markets. United States private equity firms take investments from all around the world, and many even deploy capital in global markets. United States middle-class savers are a microscopic portion of total invested capital in the world. The largest investors are institutions, like insurance companies, pension funds, and sovereign wealth funds, that are indirectly investing on behalf of the middle class. So one could argue that stock ownership is more of a representative democracy, like the US political system. As for concentration, I would think this moves in cycles. Asset classes move in and out of favor among the different types of investors. There is some concentration across industries, but generally, I think the global investing landscape is a constantly moving ground. Our next answer is from Edward Jameson. Original question: has the 21st century's growth of private equity made stock ownership less democratic, more concentrated? No original question details. Thank you for the A2A, Phil Wolf. Yes, and probably, but we are not entirely certain. This article describes the rise of financial capital firms that you mention in your question, but it does not detail who owns these firms and whose money they are investing. And also, as the article indicates, some of these entities are government agencies. 9 of the 30 largest equity firms are public sector agencies, including the British, Chinese and Norwegian governments. So at the direct level of control, yes, stock ownership is certainly more concentrated, but is it more concentrated at the financial level? I do not know how to answer that question at present. Our next answer is from Jill Silberman. No, quite the opposite, I think. You or I, assuming we are accredited investors, can get on Angel List, Funders Club, go to pitch meetings, etc., and we can invest in startup companies. With various Jobs Act regulations, we can do some of this, even if we are not accredited. Private equity growth means that companies are delaying or avoiding public offerings, and public company stock is one of the most democratic of all opportunities. So yes there, in a way. But how democratic is it that you can go to Charles Schwab, E-Trade, Ameritrade, Robinhood, etc. and place your poker bets there? What end does that serve? That is democratic in the same way as a Vegas casino that lets just anybody use its slot machines. The real question of democratic investment is whether you and I can put money into really hot small companies, like investing in Uber or Airbnb on day one. Hint, you probably could have, if you were there and had the guts and foresight, or Facebook. Hint, you probably could not have. As of the late 2010s, it is a lot easier for smaller investors to get into the very early stage startup game. Later stage, forget it. When you have $100 billion funds placing bets $1 billion at a time, hoping to double their money, if they are lucky, do you think the company wants to listen to your offer to invest $10,000? Probably not. But those aren't the opportunities you should be chasing. Overall, there is a lot more transparency and opportunity in private markets than before. Our next answer is from Richard Hom. Thanks for posting your question. Has the 21st century's growth of private equity made stock ownership less democratic, more concentrated? From my perspective, I believe that the individual private investor has had limited ability to participate in a democratic equity market. The advent of computers have created a legion of mathematicians and computer programmers that can automate trading faster than any single individual working through a stock trader could ever accomplish. Combine this technology with large private investors and you will see that only a small proportion of trades are ever accomplished by the individual private investor. Best of luck. Thanks for watching my video. Check out my other videos for more questions and answers. Also please like, share, and subscribe for more of my content. Bye.